Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katsimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.
Hello, here we are 2 days after the election. Great election, new sheriff coming into town in January. We have a situation, so what happens the day after? The market goes down 500. Today the market's down 400. Where are we going to go for the new year? So Mike Stoller and his crew of merry men are going to try to tell you what's happening for the investment outlook in 2009. My guests today include Robert Knackle, chairman of the board of Massey Knackle Realty Services, William Shanahan, vice chairman of C.B. Richard Ellis, Frank Leontonio, executive vice president of Cushman & Wakefield, and last but definitely not least, the executive managing director of capital markets, Woody Heller of Studley. So, ultimate optimist. The ultimate optimist. Where are we going to go? You know, it's November. What's going to happen in January?
Well, Michael, optimist is a relative term, and I think as a broker, if you didn't have optimism injected into your DNA when you were born, you wouldn't be in this business. But in January, we think that the liquidity is going to start to unfreeze slightly, and we think that we're going to see reasonable volume of sales continue when we're down maybe 35 or 40% from the peak.
I didn't realize this is water. Did you get Kool-Aid over there? You think liquidity is going to change in January?
It is. It has, and it's changing slightly.
Oh, you are. Oh, come on. Shanahan, what do you think?
Lucky if it's in the first half.
Frank?
I think you're talking about the second half. I think the second half.
So why is he in January? You're in the first half, second half. Mr. Heller.
What do I have left?
I don't know what you have left.
No, Michael,
Come back
look,
for the show in 2000.
It's all relative. It's all relative. I think that liquidity has loosened somewhat. We've gone through a period where there was almost no liquidity at all. And it's very important that you talk about the segment of the market that we have to look at different sales price points, because the market for properties under 50 million is operating very, very differently than the market over 50 million. The types of properties that Woody and Bill sell are very, very difficult to sell today because it's tough to find the 9-figure mortgage anywhere. But in the under $50 million market, we have portfolio lenders that are making loans, and that's what's keeping activity in our market moving forward. And if you look at where interest rates are today relative to where they were on October 10th, there is some relief that the market's experiencing.
I respect you, but I have to take a point that last week I received this capital markets report from this distinguished organization of Cushman & Wakefield, and as I read the report, it said investment sales are down by how much? Not for $50 million, for over $10 million. How much are they down?
Over 50%, close to 60%.
So over 50%. And how much of those sales that were over 50% were done because there was seller financing?
Probably over 50%.
And Mr. Shanahan, what did you say to me before? How much business have you transacted in the last 2 months?
Just a few transactions, a lot less
Why
than we
don't you say
normally
the
had.
truth? You said that you transacted 0 transactions in the last 2 months. And Mr. Heller,
Mr. Stoller.
what's happening with your transactions?
Well, not to capitalize on your line before, but when somebody, I used to say when someone asks what you do, I used to say we solve problems in the real estate business. And now when someone asks me what I do, I say I'm an undertaker, burying all my dead deals.
You know, I was going to wear black and white, but I'm told that I can't wear white shirts anymore or fuchsia. And I was going to literally wear my black suspenders and a black tie, and I was going to wear my black suit so I could truly look like a mortician. Because that's how I feel about the investment sales. The company that I work for said, if you would bring in a sale today or an item for sale, we'll throw you off the 20th floor of the building. Because they didn't want me to bring in any deals. I mean, I think, Bob, in a way, maybe the things that you see on the smaller side or maybe in the multifamily is different. But I see capital tight as hell.
Michael, you're absolutely right, and that's why it's so important to distinguish what segment of the market you're talking about. Today is a market where if you want to sell properties, you have to focus on hitting singles and doubles. And today, I'm willing to even take a walk or get hit by a pitch. But that's the segment of the market. You need to look at smaller properties because there is a lot of equity available, and portfolio lenders are willing to make loans up to about $30 million on an individual asset, and that is stimulating our market. And granted, it's not what it was, but I believe that the reason that the volume in my sector is off by 35 to 40% is more because of supply constraint than because of lack of demand or lack of financing. And that absolutely I stand by 100%.
I'd like someone else's opinion because I went to the ULI Emerging Trends this morning, and the comments at the Emerging Trends said that this is a far worse period than the 1991-92 period. It said that they project things to continue bad until 2011, 2012. You were at ULI last week in Miami. There wasn't too much different. Right. I think maybe in this small segment, but you run a big organization. I think investment sales are going to be slow. I think the banks aren't doing things because I speak to the banks more than I think you guys speak to the banks. I know you all have divisions. Why? Your capital markets boys are getting a lot of money for deals?
They're actually getting deals done, but a lot of them are smaller deals. They're multifamily. And majority of them
Bob says, you know, they're singles. They're single deals.
They're singles, and they're going to Fannie and Freddie. They're going to small regionals, but they're smaller deals.
And we've all experienced, the market's experienced a downtick in values, 10, 15%. And as people get to that level, the market moves away. So, I mean, we had a situation with a property that was basically a Class A property, had 10 bids on the property at a 6% cap rate, went back, and there were 10 bidders, went back for a second round of bids, cap rate went up to 7, purchaser pulled the property off the market. But I think if you look beyond where we are today, there's a lot of liquidity that's being put into the system. Real estate as an asset class isn't dead. And if you look historically over 10-year terms, real estate has performed well and has performed with a lot less volatility than the stock and the bond markets. So I think as the adjustment to the pricing dynamics begins to occur, and that's not going to occur until next year sometime, because I think it's going to take some time.
So do you think
prices will come down, and I think we'll find an equilibrium where things will start to trade, and we'll also find people that will have to sell. Okay, and that will establish or begin to establish some benchmarks.
But Bob said he doesn't see people selling, right? You said
no. We see people selling, not as much as had sold previously because volume is down. But I think people don't understand that the reduction in value is only 10%. Based upon everything that you read in here, people perceive that value is off much more than that.
UOI says values are down 25 to 40%.
Well, what market are they talking about?
It depends where and what type of property.
Depends, exactly.
I think maybe in the multifamily business, maybe you say it's down by 10%. I'd say it's down more than that. What would you say in the office market? You guys are, you're an office guy.
We're off 20% in the office market.
Yeah, I mean,
from the highs.
from the highs.
Right, but it's very difficult to say how much prices have changed when you don't have a lot of transactions against which to benchmark prices. The only transactions that we have in Manhattan specifically are the macro transactions. If you look at those prices of what those buildings sold for relative to the high, you could easily say those prices are off 20 to 25%. What goes beyond that is the fact that the seller, which was the bank, offered financing at a higher loan to value than is typically available from a third-party lender today, and at a lower interest rate.
What about
Therefore, the discount is
Broadway?
probably greater.
What about the building that S.L. Green on Wachovia had at 1372 Broadway, where they sold it at a significantly lower price than they had the year before, and they took seller financing? There aren't that many deals. I mean, Larry Silverstein was on my show a couple weeks ago, and he had a lease ready to be penned with HSBC. What happened on the 452 Fifth Avenue? I don't know if any of you sold it or represent, but what happened?
It was a failed auction. They didn't get the prices they wanted. They took it off the market.
Took it off the market.
Failed auction.
But those two words have almost become synonymous. There are very few auctions in the market today that haven't been failed. The ones that went through typically are the ones that happened earlier in the cycle, up to a few months ago. But there are very few auctions that have not failed, and as a result, as we were discussing before, very few of us are recommending to our clients that they start an auction process today. And to the extent that there is an auction process, one of two things occur. Either you don't set a bid date because you don't want it to officially fail, or if there is a bid date, rather than the customers, calling and saying, when's the bid date, and when do we have to get our bid in, they don't want to start bidding until after the bid date, because that's when they think the pricing is going to become more realistic, if it occurs at all.
I believe Mr. Shanahan's shop had a little property called a hotel on Central Park for sale, right?
Yes, we did.
And what happened over there?
Like everybody else, we've gone to the sidelines.
You got to the sidelines because you didn't get what you expected to get?
And on the pricing that we thought we could get, there wasn't financing available. That's been the big issue, was trying to get financing.
What do you see raw land down?
Well, the only value raw land has today, unless it's exceptionally well located, is to build residential rental. And we do have clients that are looking to acquire land, but at prices that would be reflective of a residential rental rate.
And how much is that a reduction from the prior year?
I think that from the transactions that we've seen, and as Woody said before, there's very little data points to point to. But what we've seen is value is off anywhere from 25 to 50%, depending on location, area, type. That being said, I do believe that for the absolutely best located land that's truly prime, land is not off all that much.
But you would say that land in tertiary areas, because of the lack of financing, because there's limited or no construction financing, there is no bond financing for 420, there are no 421As unless you buy these golden certificates and other things, you'd say land is down by 40 to 50%?
Land is down significantly, and if you remember, we were all around in the early 90s. In the early 90s, land went through a 2.5-year period where it had zero value. Lenders that had foreclosed on land couldn't give it away, and I remember we sold a site to RFR in 1993 for $20 a buildable foot up on the Upper East Side, and that was a remarkable sale at that point. Land will not get to that point today, I don't believe, because I think that there is such demand for residential rental that at whatever that price point is, land will move. But clearly, condominium construction in secondary and tertiary areas is not going to occur today based on a new land sale.
The word condominium has left the dictionary. It's no longer there. You know, it's been taken out of the terminology. You know, it's like $500 a square foot land prices, or hotel rooms selling for $1.5 million. I don't think that happens anymore. When is the appropriate time to go to market for properties? When is the world going to get brighter?
First is, if you're asking us to sit here today and anticipate when the time will be on the calendar in advance.
The topic of the show is investment outlook for 2009. I have to look today.
It's a fair question, but that's very difficult because that's completely speculation. What's less speculative is what forces need to change to enable us to not have a failed auction, right? So as we've said before, you've got the confluence of events here at the moment, which is what's killing the market, of the absence of debt and a challenge in the economy. But people always have different views on the economy and where values are heading, and people will be willing to take positions one way or the other on that, as long as there's financing to enable the system to move forward. So when will it occur? It will occur when financing begins to become available. Now, we all say there's no financing available. I challenge that slightly, because I keep meeting with lenders who say we have money. The problem is the money is so expensive that deals can't tolerate it. So there will be more lenders that will have money and at prices that make deals economically feasible, and that's when we'll see, I think, in 2009, when the market will again become active.
Frank?
That's because the prices are still too high, right? There's still a disconnect between where the price needs to be today in order to attract a buyer, and when we've seen this in other cycles, when properties reach the right level, okay, smart money comes in and buys, okay? In the absence of debt, they'll put equity together. And some of these debt funds are going to be able to get very attractive spreads. And once the properties seek their proper level, because they're not at their proper level today, they will begin to trade.
You're going to almost have the reverse of what we've had a year ago. People used to go out, put in their bid, lock in a price, and go get financing. I think the reverse is going to happen is you're going to figure out at what price you can get financing, lock in your financing, then go put in your bid.
Don't you believe that more sellers are going to take back financing?
They're going to.
Absolutely.
Absolutely.
And don't you believe that there's going to be there's going to be contingencies? Remember, you used to sell property, there was no contingency. You're going to buy it. That's it. Don't worry about it.
Where is,
and
no
Robert?
reps, no warranties.
Well,
I miss the good old days, Michael.
I think the question's an interesting one of when the market's going to come back. I think that we're in a market where things are going to remain challenging for at least a year or two. The most bullish economists are saying that the economy will bottom out sometime second or third quarter of next year. The most bearish I've heard have said that it will be at the end of 2009. And one of the things that we have to be very cognizant of is the fact that the most profound metric for our fundamentals in the real estate market is unemployment. And because unemployment is a lagging indicator, it's very likely unemployment is not going to spike until after the economy has bottomed out, which means that we could see a height in the unemployment rate sometime in early 2010. If that's the case, that will affect very much what happens to real estate and real estate values, because with reductions in jobs, you lose square footage demand for office buildings, you lose the ability of someone to go from a one-bedroom apartment to a two-bedroom, or from a two-bedroom to buy a co-op or a condo. So the outlook is that things will remain challenging. And it could be a couple of years before we start to see some traction.
You bring up some very good points, which I don't want to tell, but I will tell my viewers that in earlier generations of their life, these two gentlemen were appraisers, and appraisers, make up values of what the values are, and the valuation is very specific. What you just said, if rents are lower, if somebody has to pay lower amount of rent for their office space, what effect will that have on the valuation of a property?
Values have to go down. There's no question. But I would also suggest to you.
And what about the January tax increase to make up the budget deficit in New York City?
Anything that's going to increase expenses has a negative impact on value. But I would also suggest to you that values are lagging the market, and they always have, and I think they always will. They don't lag as much as they used to, but if you look at the NCREIF index today, it's not really off that much. Whereas we're all acknowledging here that property values are probably off 20–25%. So I think it's a lagging indicator, but there's no question if you're going to hit the expense side of the ledger, something has to give, especially in a capital constrained environment. That's more expensive. Values go down.
But let's look at certain values, because I think Robert he was saying that residential values in the market that he sees hasn't really gone down more than 10%. What about in the hospitality market? What do you see? With the exception of the Central Park property, let's talk about other hospitality.
We haven't seen that effect yet. So I think we're just starting to see occupancy rates starting to dip. We're starting to see the rack rates dip a little bit, but there'd been a fair amount of support from the European traveler.
I was with Jonathan Tisch yesterday, and he said to me they're already seeing business travelers are not making plans. He said, you know, this was marathon weekend. In the history, in the last 10 years, he's never seen a time that you could get a room on marathon weekend. The major hotels had vacancies this marathon weekend.
Wow.
Wow.
I mean, and for Jonathan Tisch to say it, you know, he was the chairman of New York City and Company. He said that there is really, this is happening. He said he's scared for the hospitality. What about retail? What about retail values? I mean, everybody's projecting the worst Christmas.
Retail has got to get hit more than any other sector other than hospitality. I mean, if you just think about disposable dollars and everything that's happening in the economy and the unemployment rates, retail is one that has to get hit.
Yeah,
No
consumer
question.
spending is at a 28-year low and is not going to get better before it gets a little worse. So retail is a big concern. But that being said, one thing we have to keep in mind about retail, and you have to look at the fundamentals, is that in the United States, major cities have about 22 square feet of retail space for every person that lives in that city. New York only has 7. So we are grossly under-retailed.
New York City urban retail is fine, but if we go to New Jersey, which is a little different, or we went out of the 5 boroughs, I think retail is going to be hurt.
Well, one of the reasons that retail is going to be hurt is because consumer spending was fueled by people being able to borrow money against the increased value of their home. And if their home values are dropping and they can't increase their mortgage, they're not using that money to be able to spend.
But wasn't that also the fact by owners of commercial property, they were able to refinance their properties? And that gets back to my question, which I had prior to the show. What's going to happen when some of these landowners, these owners of property, their mortgages come due and the rents which they hope to get are not realized? What's going to happen?
And Michael, there's going to be a very significant deleveraging that's going to happen that will force property owners to sell, some of them who over-leverage their properties. And that effect is going to take place over a number of years, because if you look at the 2005, 2006, 2007 vintage loans that had very, very low rates, but the trade-off for the low rate was taking a shorter term on the loan. As those loans mature, those owners are left with 4 choices, basically. They either come up with additional equity out of their pocket. A lot of owners of small to mid-sized properties don't have that additional equity. They bring in a preferred equity partner, which essentially will squeeze them out. They try to sell if they think they can still get a price that will satisfy the bank, or the bank is going to take the property back.
You know, it's very interesting that I'm sitting here and I remember that you sold a property, and you may have sold a multifamily where the greedy investment bankers lent too much money. What's going to happen on those properties which are over leveraged, these trophy properties called Peter Cooper Village, Delano, Rivington, all of these apartments? What's going to happen when their debt service coverage and their reserves aren't there? What's going to happen on that?
You know, it's not a matter of whether they're trophies or not. I think if a property is servicing its debt, I think you're going to see the lender do whatever they can to extend the loan.
What if the property is not servicing the debt?
It depends by how much, doesn't it?
Let's use a good example. Let's take the reality of a property up in Harlem, which was built at the same time as Peter Cooper Village, called Rivington. It has a $250 million debt today. It has debt service that can service about $40 million of debt. To me, I'm not the best in math, but you know that says there's a difference of about $210 million. What's going to happen to that? What's going to happen to Stuyvesant Town?
I think it's the same answer everywhere. There aren't that many choices. You either have the owner come out of pocket, which is unlikely in the scenario that you describe, or you have the bank take it back, which is what we saw in the last cycle predominantly, or you have the lender working with the borrower to restructure the loan.
Now, if the bank takes it back, what effect does that have on the emotional effect on values and everything else?
Well, that's an interesting point, Michael. We're doing a couple of note sales now and selling some properties for banks that have foreclosed. And the perception from the buying community is that there's distress, this is going to be a bargain, we have to get in. We recently went to market with a portfolio of multifamily buildings. The lender is going to sell for less than the amount of their mortgage, but the buyer is going to get less than a 5% return on their investment. That to me is not a tremendous opportunity, but that's where the market is. So we're not seeing the carnage that one would think with the opportunistic buying opportunities. The buying opportunities are still at high levels. The lenders may be affected negatively, but the buyers are not seeing tremendously great opportunities out there.
Quick question, 2009 a good year, or is it going to be 2010? Could you guys go on vacation for a year, or are you going to be able to do some business in 2009? Mr. Shanahan.
We'll be doing business in 2009. It's probably going to be largely based on distress.
Absolutely. There will be a lot of opportunities in the distressed area. And as the year progresses, I think we'll begin to see some thawing in the market as we approach 2010.
So should we wait to 2011, Mr. Heller?
The great fortunes in real estate have been made at the beginning of the recoveries. So for us to all go on vacation and not be part of that process would be an enormous mistake.
In the worst of years, in 1990, 1991, when volume was at only 1.6% of the total stock of properties, 2,000 buildings sold in New York City. 2,000 buildings will sell again next year. And while that might be a low percentage, I want to try to sell as many of those buildings as I can.
So it sounds to me that even though I'm the eternal pessimist sitting with the four optimists, you think things are going to get much better?
Ultimately, next year may be a little more challenging than this year, but ultimately things will turn around. I think real estate is viewed as a much more tangible, better quality asset class than it ever has been.
Mr. Shanahan?
I think you're going to see some real buying opportunities in 2009. Those opportunities are not necessarily going to be real estate related. You may have positions in real estate. You may have notes. There's going to be, I think, some creation of interesting financial instruments resulting from, as you say, the deleveraging process with these properties.
To take this show properly, I need a couple of hours, but in half an hour, I've got some really good thoughts. I'm really happy that I've had some good friends and leaders in the industry. I'd like to thank Bob Knackel, Bill Shanahan, Frank Leontono, and Woody Heller. Next week, since you spoke about hotels, I got the hotel boys. See you next week.
Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackel Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.